The market is entering a very dangerous and overvalued phase with AI hype, optimism, and future earnings already priced in for many stocks. So, in this video, I want to talk about the logic that you should be using to actually do well in a market where things are not that cheap. Look, historical warning signals right now are flashing, literally flashing. Look at the Shiller PE ratio. Shiller PE is a very important metric that I personally look at, that I studied in my undergrad education in finance. And right now it's around 40-ish. That's very high. If you look at the Buffett indicator, it's at around 215%, which is basically at extreme levels only seen during major bubbles like the dot-com era. Now, I don't want to scare you too much. I just want to give you the facts, and I'm going to talk about how you can protect yourself, the strategies that you can use when you see euphoria in the market, and how you protect yourself. Because when things are high, you got to be cautious, right? So these are levels we've only seen only a couple of times, dot com and other times that didn't really end too well. And I'm not saying that history is going to repeat itself, but it certainly is likely that it can repeat itself, and I want to put this into perspective right now. I think there's a lot of good stocks in the market if you know where to pick. I'm going to talk about some of those good stocks, but the general picture is this: retail investors are making some mistakes. They're making classic mistakes like buying high and selling low. And that's a really big issue because when you buy high and sell low, you lose money. And when you lose money, it's hard to recover from that, right? So myself personally, I'm a fan of making a little bit lower returns, but also reducing risk and really focusing on proper risk management, which is really looking at fundamentals and technicals. Now, retail investors, they always show up late to the party. It's like the champagne's almost gone and they come in and they're like, I'm ready, right? But the champagne's almost gone. So they're kind of late to the party in a way. And they don't really realize that insiders have basically already cashed out a lot of profits. That's what I see a lot in the market right now, is that smart money is being more careful. And the core principle that I want you to understand here is that quality investments are going to be the best thing that you can do right now, because I see some Looney Tunes stocks that are rising hundreds of percent, right? And some of them are in the AI space, right? I won't mention specifics because there's a lot of them. There's just a lot of stocks, and the stocks that I talk about on this channel and the stocks that I have in my Discord community, those are the stocks I personally believe in, right? The AI industry is still strong, but there's a lot of stocks that have run up a lot. So I want to caution you to be careful with some of those stocks, because there's something called seasonality. Seasonality is when certain stocks, they go up a lot, and that's fine. That's normal. It's smart to sometimes ride that momentum. We also have to understand that the cycle may change, and I can see that happening in the near future. So you need to hedge yourself. You need to have proper diversification. You need to have proper risk management. These are all topics that I want you to know, because whether you're part of my Discord community or just watching my videos, I still want you to have the best results possible, right? And the time to buy is usually when things don't really feel right, when there's a lot of panic and chaos in the market. That's actually a good time to buy. And when things are extremely high, they're giving you these promises, right? The market really rewards pain tolerance. So when the market is going down and you're one of the few people that decides to catch a falling knife, that is the opportunity. That's where riches are made, when people take opportunity to buy when no one else is buying. Right now, when everyone else is just chasing things and stocks are at all-time highs, like Nvidia, like Palantir, I want to caution you because there are better alternatives. For example, AMD. I think AMD is a really good investment because AMD is a lot cheaper than Nvidia right now. Same thing for Palantir. It has been hovering around 180, but it's not really going up anymore. So there's no more momentum. So why be invested in a company right now that is expensive and doesn't have any more momentum? I want to put that into perspective. I'm not a bear, and I'm not turning bearish on the overall market, but I want to put into perspective, because a lot of people who are mega bulls, you guys need to understand the opposite side of the story, that it's very expensive right now, right? So sometimes I personally rather miss out on gains but have really good risk management in place. And for me, I believe that that's what makes me a good investor and a good coach, is I'm not chasing home runs all the time. I'm not chasing to make all the money in the world. I am really after stability, consistent income that is safe. That's my personal goal. I want to achieve good results without having to suffer in times where the market is going to pull back. And market crashes are very normal. So that's basically a recurring cycle within investments. They're not accidents, they're actually designed all the time. They're like literally designed to take money from people that have more experience, more patience, and other qualities as good investors. They take it from the investors that don't have those skills to those that have skills and patience. So market crashes are very normal. And bull markets like we're in right now are summer romances. They feel endless until reality shows up with the bill. And I'm feeling that recently myself. Man, not in investing, but in real life, I've had that happen, right? You got a romance story and then boom, the bill comes. It's not good, right? So you got to wake up to the realities of life that you got to be careful in all things, right? Investing especially. If you look at the S&P 500, it is not risk-free. It is not. It's heavily concentrated in the top 10 stocks. There's very heavy concentration on Mag 7 in the top 10 stocks, and I like them. I think a lot of money is pouring into them, but you still have to understand that people call the S&P 500 diversified, and it's becoming less diversified because right now it's very tech heavy. It's basically like a tech heavy rocket. You know, if the engine goes out and fails, rockets don't glide when engines fail. So right now we're on a tech heavy rocket, and you got to hedge. Some of the strategies that I talk about on this channel, you can watch my other videos here on this channel. I have a whole playlist on option trading. There's a lot of strategies that I would be using right now to generate income, to protect yourself, to hedge. There's a lot of strategies that you can use. And if you look at professional investors, they protect themselves through diversification, through trimming winners. I haven't talked about this for a long time, but trimming winners. If you have a huge winner, it is okay to pay taxes, trim, have a realized gain, pay some taxes, and reinvest that elsewhere. That's perfectly okay. And it's also okay to have bond exposure. I don't have any bonds myself, but for me, you can have a safe investment like a bond through a dividend paying stock. So going into dividend paying stocks, they have a bigger floor, they have a stronger floor, a stronger foundation. So avoid trying to predict the next crash. You're certainly not going to do that. You may get lucky, whatever this video gets, let's say 20,000 views. Maybe there's 1,000 out of 20,000 people. You can time the market, but in a short amount of time. Timing the market a long period of time, forget it. Absolutely forget about it, right? So instead, use a structured plan. The best structured plan that you can use, hands down. This is the best. I'm not a financial advisor or anything like that, but this is what my formal education taught me. The best structured plan that you can have is dollar cost averaging. That's why recently in my Discord community, I bought some shares of Meta. I like that Meta fell down a bit, and I bought 25 shares of Meta. And my goal now, I told my Discord community, is we're going to acquire more Meta. When we get to 100 shares, we're going to sell covered calls. And I didn't want to buy 100 shares of Meta because it's a lot of money. It's a lot of money for anyone, right? That's a lot of money. 100 shares of Meta is like 70 grand, right? So I think that it's great opportunity to dollar cost average into it. Even if you can't afford 100 shares, you can afford whatever, 1 share, 2 shares, and just continue to add in dollar cost average. As an example, Meta, right? A structured plan like dollar cost averaging and adding more during downturns and waiting for good opportunities is the right way. You shouldn't wait and have 100% cash. That's just definitely not the right move. I'm not a fan of timing the market at all. I'll put that on the line right now. Do not do that. But it's good to have some cash on the side, a little bit. It's good to add more money into your account, especially during downtimes if you can, or just focus on dollar cost averaging. You don't need to be super sexy to make a ton of money. You don't need to outsmart the market. You don't need to, all you really need to do is outlast it. You don't need to outsmart the market. You need to outlast it. That's probably one of the best metaphors or analogies I came up with, right? Systems beat emotions every single time, guys. So sticking to a system of dollar cost averaging is way better, especially because if you think about it, emotions are like the biggest risk. If you actually want to be a good investor, it's discipline, it's patience, and diversification beats basically every single other strategy, and it wins over like trying to time the market and speculate. That's not how you actually make money. So if you're a beginner and you think that this technical indicator is going to make you wealthy, no, it's not. It's by just sticking to the simple basics. That's why in my Discord coaching program, I don't do anything super complicated. I just go over the bread and butter basics. I put out trades that I believe in. SoFi has made a ton of money, and I look for quality companies. And I focus on the long term because long term investing works. 90% of decades, right, in any given decade, 90% of them are profitable, and 100% of any 20-year cycle, 20-year period, has been profitable 100% of the time, and 90% of a decade is profitable, right? And if you know how to hedge, if you know how to dollar cost average, that number is even higher, right? It's way higher than that. So I want you to be ahead of the curve. I'm very results oriented myself. I want everyone to get results, and I want people to be diversified and understand some of the warning signs. This is truly, for me, I think, I hope not. I hope I'm wrong, but I think a once in a lifetime event is coming, which is basically like, a 10% pullback, something like that. Nothing too crazy. I'm not trying to predict the market crash that's going to be too crazy, but I think we're going to get a pullback because things are not cheap. Things are not cheap. So I think this is really like, I would say, a once in a lifetime event may happen. And the way you want to prepare for this is by trimming some of your massive gains. Palantir, massive gains. It's not really cheap anymore. And what has come up fast may also come down fast. So that's why my personal positions, they're geared towards safety and quality. So dollar cost averaging is like an automatic gym membership. Just attend the gym and you're going to get results because you're consistent, right? So your portfolio doesn't need to be sexy. It needs to survive and how do you say that analogy? Like test time, be the test of time, which is having like 10 to 15 high quality stocks. One of them, for example, is Amazon. It's down years to date and trading below historical valuations. AWS is gaining 20% growth. It's growing pretty quickly, strong cash flow, and it's really has potential to rebound to all-time highs. So I'm looking at stocks that no one's really like talking about. It's not like the next crazy stock that's going to get a 50,000 or 100,000 views. And I don't care. I'm just trying to get you good results. Amazon is a good example. AMD is a good example because AMD is gaining AI market share. It's cheaper than NVIDIA. So I'm looking at value plays right now. I'm looking at opportunities in the market for stocks that are not all-time highs. So I will do some more stock research. I'll have some more on this channel. And I personally plan to continue to trade and make the students that I work with money. So if you're interested in learning more about my Discord community, click the first link in the description. Either way, please stay safe. Be aware that right now the market is not that cheap, right? So hedge, be protected, and I'll see you in the next video.